Hi, I'm Jenny Brown. Welcome to this week's MFB News. I hope you are well, that you've had a really fantastic week. This weekend coming up is the one where we're going to get our trees up, I believe. At Mortgages for Business, 1st of December, we were straight in there, as you can see, the tree behind me glistening away there. So what we've got for you this week, we're going to be doing our usual roundup of what's been happening with interest rates. There have been further reductions in the last week, so things are definitely feeling much more positive than they were a few weeks ago. So I'm going to be sharing what's been happening there. I'm then going to be talking about the latest predictions on what's going to happen with base rate. Things have actually been revised, so it's worth just having a look at the latest predictions, so you can get a feel for what's going to be happening, or predicted to happen, I should say, over the midterm. And then finally, we're going to be talking about the latest house price index that's been released with Nationwide and what's going on with property prices at the moment. Interest rates then, so what's been going on? So first of all, just to have a look at where swap rates are. So 5-year swap rates are still hovering at around the 3.7% mark. So the good news is they haven't gone up, the bad news is they haven't gone down either. Things are just largely kind of settled now, which is what we've been thinking would probably happen. So when we're talking about the fixed rates and interest rates, keep in mind lenders who are using the money markets to fund their mortgages, they're paying circa 3.7% on 5-year fixed. They need to make a margin or charge a margin of around 2 to 2.5% to make the deal or make lending profitable. So that means that actually realistically, rates of 5.7 to 6.2 are kind of where things need to be for the lenders to be making margin. Now, not all lenders lend off of money raised in the money markets. Some lenders are lending off balance sheets. That's so you'll kind of think about those banks that you would save money with. So if you walk into a local NatWest branch, for example, what kind of rate of interest are they paying you on your savings? These guys, their cost of funds are much cheaper, so you can expect a slightly lower price from these guys, but we'll go into that in a bit more detail in a moment. So what's been happening with those lenders in the last week? So Kent Reliance have reduced their rates. They've brought out some actually really quite attractive 5-year fixed rates. Pricing here now starts from 5.49%. Now, the good thing with Kent Reliance, I would say they are definitely one of the most flexible lenders that we work with. And we work with a lot of lenders here at Mortgages for Business. So individuals and limited companies, no maximum number of properties in the background, no minimum income. Now, with the limited company structures, we can have straightforward flat companies, we can have layered companies. The other interesting thing with Kent Reliance in terms of the limited company piece is that they're only taking personal guarantees from the directors of the company. So that's who they're underwriting. So that means that you can have some fairly sort of niche structures in terms of the shareholders. So, for example, family investment companies where you've got, mum and dad who maybe own, say, 50% of the company, and then you've got a couple of kids owning another 25% each, just as an example. So this can work really well for those guys. That wouldn't fit with every other lender. Other things with Kent Reliance, they can do day one remortgages against market value as long as you can demonstrate you've added some sort of value to the property, i.e. refurb. They're very, very good at people with minor credit blips. They can consider, properties next to and above commercial premises, ex-local authority, that kind of thing. So really, really flexible lender. And like I say, the rates they brought out from 5.49 are very, very good. Now, Precise Mortgages, who are part of the same group, so Precise and Kent Reliance are both part of the One Savings Bank group, have also brought out a 5-year fixed rate. Their pricing is also from 5.49%. Now, the difference is that Kent Reliance, on their lower fixed rates, are charging a 3% fee. For the same interest rate, Precise are charging a 2% fee. So a slightly more competitive deal. The difference between the two lenders is that Kent is definitely the more specialist lender, Precise is a bit more kind of mainstream. So with Precise, you're sort of looking at limited companies and individuals, no maximum properties in the background, no minimum income requirement, but in terms of the kind of more complex side of lending, layered companies, day one remortgages, that kind of stuff, Precise, this isn't their bag. You'd need to go to Kent Reliance for that. But great to see One Savings Bank, bringing out some fantastic interest rates. So thank you very much to those guys. Now, we've also seen Accord reduce some of their rates and introduce some higher incentives. So what that means is essentially cashbacks on deals. When we're talking about cashbacks, we're talking about, maybe £500 towards your legal costs. So they've kind of upped the ante on the cashbacks and dropped down their fixed rates. We've seen BM Solutions drop their rates as well. So their 5-year fixed rates are now from 5.52%. BM Solutions are kind of what I would call probably one of the longest standing sweethearts of the buy-to-let world. That's an unusual term, isn't it? So these guys are, they're a big player. They're very standard in what they will do. So individuals only, maximum number of properties in the background is 10. They restrict the number you can have with Lloyd's Banking Group. They are quite good on some unusual property types, so studio flats, flats over commercial, high rise, that kind of thing. But pretty vanilla lender, but rates from 5.52% here. We've seen Fleet Mortgages reduce their 5-year fixed rates. These are now starting from 5.49. Fleet would fall more into the kind of, I would put them in the same bucket as Kent Reliance in terms of being a specialist lender. So, no maximum number of properties, limited companies, can be layered, day one remortgages, all that kind of really great stuff, which a lot of our landlords really enjoy. We've seen land rate reductions on their 2-year fixed rates. Their 2-year fixes are now starting from 5.24. And we've also seen Principality reduce some of their rates as well. So another really positive week in terms of pricing. So where does this kind of make things sit in the round? So if you're an individual and you're looking to borrow against a very vanilla property, your 2-year fixed rates are now from 4.29, your 5 years are from 4.69, variable rates are from 3.24, and any product with no early repayment charges from 4.3. Same again for limited companies, so 2-year fixed from 4.89 this time, 5 years from 5.29, variable rates from 3.49, and products with no ERCs from 4.74. In terms of what your peers are asking for when they're picking up the phone to us at the moment, we saw a real wave of people saying, actually, I want to take a variable rate and I don't want any tie-ins. And that was understandable because people just wanted to kind of keep the rate as low as possible, but have full flexibility to jump out of the variable rate at any moment in time, should they wish to sell the property or mortgage on to, or move on to a fixed rate product. Interestingly, now what we're starting to hear people asking for more is 2-year fixed rates. And that's because, and when we come on to what's going to happen with base rate in a minute, you'll understand why. The reporting is that actually we're going to see a peak in interest rates over the next 12 months, and then probably things are going to start to ease off again. So people are saying, well, okay, I'm going to take a 2-year fix, and hopefully in 2 years' time, rates are going to be much lower. Now that's a really, absolutely, bona fide, commendable approach to take. There's a couple of drawbacks with 2-year fixed rates at the moment. So first of all, there just aren't that many of them around. 2-year swap rates are higher than 5-year swap rates. The cost of lenders bringing money on the wholesale markets on a 2-year basis is more expensive than 5 years, so it's quite hard to price these competitively. The other thing is that rental calculations are still proving to be slightly challenging for us. So actually the rental calculation is more restrictive for 2-year fixed rates than 5-year fixed rates. So a lot of borrowers will struggle to get the amount of money they actually want to borrow on a 2-year fixed rate. But that aside, actually, if you can get a 2-year fixed rate, that could be a really good answer for people. The other reason people are kind of turning away from the variable rates is that obviously base rate has been going up, and therefore these rates have been increasing, and so actually they're looking less and less competitive as time goes on. There's another base rate increase expected in December, so you see those rates increase again. So actually the kind of tipping point has happened. Variable rates are now looking, largely unattractive. There are some which are still looking pretty good, but in the main quite unattractive now because they've just been increasing, so people are now turning their attentions to 2-year fixed rates. Okay, time to get our crystal balls out and have a little look into the future in terms of what's going to be happening with base rates. So after the mini budget, there was a lot of reporting saying that base rate was going to cap out at 6.5%. And this number has been revised downwards, and depending on which economist you're talking to, the expectation is that actually base rate is going to hit circa 4% by the early part of next year and 4.5% by the middle of next year, and then it's going to stay there up until the end of 2023, so December 2023. So why is this? So the expectation is that actually inflation could start to fall towards the end of next year, and this is going to be due to energy prices coming down and also a loosening of the labour market. And this means that actually, if inflation starts to ease, base rate starts to come down. So the expectation is that actually in 2024, base rate will reduce to around 3.25 to 3.5%. And this kind of echoes back to what I was saying, that some borrowers are now saying, I think I'm going to take a 2-year fixed rate and kind of just ride out that curve and then revisit things in 2024, 25, and hopefully I'll be able to obtain a lower interest rate. So I think the really good news here is that actually, if we kind of timeline things, the next 12 months are going to be the most challenging in terms of inflation, cost of living and interest rates. But actually, you know, after that point, people are genuinely expecting things to start to ease off. So if you can just get yourself in a really strong, solid position to cover off the next 12 months, I think actually we're going to be okay and things are going to start to feel much more comfortable, which is some really positive news, which I think we're all incredibly glad to hear after the last few months. Right, so those of you who watch the news or listen to the news or digest the news in some way, which I think is probably all of you, will have heard the news about the Nationwide releasing their latest house price report, and that house prices fell by 1.4% in the last month. So just to kind of go through those numbers for you, so Nationwide has again reported that house prices fell by 1.4% month on month in November, while year over year growth dropped to 4.4%, which is down from 7.2% in October, which is well below the kind of expected 5.8%. So this is the second consecutive monthly fall in Nationwide's measure of house prices in November, confirming that prices are starting to buckle in the face of high mortgage rates and squeezed disposable incomes. Okay, so what's going on and why? So when I was listening to Rob Gardner, who's the chief economist at Nationwide, talking about this, what he was essentially saying is that after we had the mini budget, because of the spike in interest rates, the lenders had to revisit their affordability calculations. And this is really looking at residential mortgages now rather than buy-to-let, although we've obviously seen that kind of impact buy-to-let by way of the rental calculations as well. So what they're saying is that essentially more and more people who were planning on buying a property are being squeezed in terms of their mortgage affordability, either because the lenders have adjusted their kind of numbers that they use, or that actually borrowers are looking at interest costs and saying, do you know what, this is just actually too expensive at the moment, I'm going to park it for the time being. So with less first-time buyers coming to the market and more home movers also thinking, well, actually at the moment we don't really want to move house and take on larger debt, this is really starting to slow down the housing market, and that means that prices are starting to really come off the boil. Okay, so where are we expecting things to go next year? Because I think this is the thing that actually everyone's really interested in. So the general consensus across the board, when you read all the different reports, and there's lots of reports floating around this at the moment, is that house prices are going to drop between 5% and 10% in 2023, and then start to recover and grow in 2024 again. And by the end of 2025, we're going to be back to where we started. So the damage is not going to be irreparable. We're not going to be all in kind of dire straits and the world's going to end or anything like that. We're just going to see a dip, which actually, if you sit tight, hold out, then actually this really shouldn't impact you too much. It's only if you really bought in the last kind of 6 to 12 months and you sell in the next 6 to 12 months that I think you're going to feel the biggest impact. So that's kind of the plan at the moment, or the predictions. I'm sure these things will change, and actually the predictions that have been impacting what people think is going to happen with house prices is largely driven by the expectation of what's going to happen with interest rates. And now the forecast has been adjusted for what's going to happen with interest rate. This could then impact again what people think is going to happen with house prices. So things are moving all the time at the moment, which is why our reporting does tend to vary week on week. But as always, we'll try and keep you as up to date with things as we possibly can. And that's me for this week. Thank you, as always, for joining us. If you do have any questions, give us a call, 0345 345 6788. Or as you will know by now, our website is a plethora of information. Have a really amazing weekend. Enjoy putting your decks up if that's what you're up to. I think the weather's about to turn really cold as well, so get your long johns out. I will see you again same time next week. Take care until then.